So I think the biggest economic story is that inflation is still running above target at 3%, 1% above the Federal Reserve's desired target. The labor market is in a very interesting situation where there's almost no hiring going on.
The single most important takeaway for the average American is watching whether or not the slower hiring that we have seen this cycle will morph into increased firing. If we go back to past economic cycles, typically it's slower hiring that comes first, and then we see an increase in firings, a big uptick in the unemployment rate. But what's been really unique about this cycle is that we've been seeing slower hiring for the last couple of years, and it's not resulted in increased firing. So the big question is whether US corporations will turn to increasing firing, mostly if they're seeing margin pressures in certain areas. It remains a question that has been in place for this market and for this economy for the last 12 months. So it's a big question of when we'll get that answer. But one of the reasons why we have seen such a strong market is that it's become incredibly concentrated and driven by just a few handful of names benefiting from this massive AI CapEx cycle. And the reality is that that is also actually driving the economy as well. We're seeing AI CapEx become an increasingly large part of US economic growth.
However, it's important to realize this is a very, very concentrated rally. And so it is essentially a contest between momentum on the part of many of these technology companies and valuation, which is looking very, very stretched, particularly in that sector, but even across the broader market. On the other hand, you have the economy, which is growing relatively slowly. It grew at 1.6% during the first half. And you have essentially a job market that is stalled out, inflation running above target. And all of this creates a very, very mixed picture.
The single most important data point is the divergence between what's going on within the market cap earnings of the S&P 500 and the equal weight S&P 500. This captures the fact that there's a huge dichotomy between what's going on with the top-weighted part of the market, which is benefiting from things like AI and CapEx, and what's going on within the average stock, which much more reflects what's going on within the US economy.
When it comes to a cooling economy and a resilient stock market, absolutely they can coexist. And so the perfect example of this is the mid-1990s. In 1995 and 1996, US economy slowed into a soft landing. And the stock market loved this scenario because the Federal Reserve was able to ease policy. They cut 75 basis points off of rates, and the stock market was up over 30% in 1995 and up a further 25% in 1996.
One of the greatest questions is how the market can be so strong, but how average Americans can still be saying such sour things about their outlook in the economy. A very common trope is that the market is not the economy, and that is very true. What drives the market, what drives earnings can be very different than what drives the US economy.
If you look at the consumer confidence surveys, like the University of Michigan and the Conference Board, we've seen a very, very sharp drop-off in consumer confidence. When you look at the actual spending data, consumers continue to spend. So where's the disconnect? Well, the disconnect is that people with incomes of less than $100,000 have tended to spend a lot less money because they're feeling a lot of financial strain. So one of the big questions, though, is are we really in a soft landing environment like we were in 1995 and 1996? At that time, inflation was well behaved, running at 2%. This time, with inflation running above target, in some ways it's more reminiscent of the early 1970s, in which Fed Chairman Arthur Burns kept interest rate policy easy and actually lowered rates in the face of an expanding economy that later on set off a tremendous inflation in 1973 and 1974. So we have an economy that's kind of growing slowly. It's a little bit overheated with inflation still slightly above target, and the central bank is easing policy.